Truth is, I thought it mattered. I thought that
money
mattered. But does it bollocks? Not compared to how people matter.
Welcome, mentioned and other fine folks, to the Sunday Dispatch of the Black Letter, where we contemplate thoughts worth thinking. And there's a bunch of thoughts on the go today. As we continue to live in the upside down, the topsy-turvy world with all sorts of shenanigans and nonsense going on. So let's take a look what we've got on the agenda today. We're going to look at obviously stock markets, precious metals, but mostly on the agenda today is actually economic news and where things are going there. So we'll take a dive right in. Here at Michael Roberts' blog, we have Deficits, Debt, and Deflation After the Pandemic. It's a great article, the one we will look at mostly as we go through today's agenda. So the great lockdown enforced by the COVID-19 pandemic has driven governments across the globe to apply extensive bailout and fiscal stimulus programs. On average, these measures of wage supplements, furlough payments, loans and grants to firms, and emergency spending on health and other public services have been paid for by extra government spending equivalent to an average of around 5 to 6% of GDP, and that's twice as large as the fiscal monetary stimulus and bailout packages delivered during the Great Recession of 2008-2009. We can see that here. These are the different countries. The United States is looking quite small there compared to Italy and Germany, but we'll see if that has any cause for concern. So far, countries around the world have used about $8 trillion to fight the pandemic. IMF forecasts that general government budget deficits will reach 10% of GDP in 2020, up from 3.7% in 2019. The US government will have a 15.4% GDP deficit. The public sector debt ratio in 2020 will reach 122% of GDP in the advanced capitalist economies and 62% in the so-called emerging market economies. And you can see here it's at record debt. Global public debt is expected to exceed the post-World War II peak. As we can see here, we're just practically there, if not already slightly above it. After the end of the Great Recession, the predominant view among governments and economists alike was that public debt levels were too high and would damage economic growth rates and or even engender a further financial crisis. Top economists like Rogoff and Reinhardt argued that there was empirical evidence over centuries that showed when public debt ratios were above 90% of GDP, the probability of a financial crash was very high. The more extreme Keynesian position that is now popular is that even managing debt levels does not matter. This is, of course, modern monetary theory. If government spending outside covering interest costs on existing debt continues to rise faster than tax numbers, then this primary deficit will continually add to total public debt. This means that the interest cost of the debt will rise even if the rates of interest is very low. And you can have a look here too. This is the debt to GDP ratio on the left-hand side at about 120%. This is the interest to tax is over 10% currently. Advanced economies, the maturity of public debt, the period before repayment of bonds is required is about 7 years on average. The longer the maturity, the less the impact of increased deficits and debt on debt servicing. Here's the public debt held by the private sector, and average maturity, as you can see, is about 66 or so months. Inflation costs and higher interest rates for borrowing across the board, so government spending, Keynesian style, can only be a substitute for failing private investment and consumption for a short while. Ultimately, it is a burden on capitalism, not its savior. So talking about high inflation and high interest rates can be a concern. You can see here the productivity of debt has been going down since the early 90s, and now it's actually in negative territory, right? This is the incremental debt output ratio. The blue line measures levels of growth returned per unit of debt added. So now we're having negative levels of growth with each unit of debt. Governments could just print money to pay for their debts. They have that unique power, as MMT argues, but that would eventually mean devaluing the currency used to pay for things. When you devalue currency, what's happening? Inflation. Debt and growth. Corporate and household debt were already high at the end of 2019. And here's the USA. This is the IMF 2020 economic growth forecast. The right scale is at about minus 8%, as you can see the gray line. And this is household debt, and this is corporate debt. We're sharing the burden equally, it appears. A whole layer of zombie companies where debt interest is not covered by profits, that this blog has talked about before on several occasions, are likely to go bust before normality is restored. I think that's inevitable for sure. This is the number of companies filed for Chapter 11 protection compared May from every given year. You can see we're at pretty much all-time highs almost. I think the next few months, perhaps into next year, will be even worse. The amount of debt classified as distressed in the US has surged 161% in just the last 2 months to more than $500 billion. And so far in 2020, the pace of corporate bankruptcy filings in the US has already surpassed every year since 2009. These are huge numbers we're talking about, folks, and we haven't even seen what the outcome of all this is going to cause over the next maybe year or three. Money supply, as represented by deposits in banks, which is the M2 money supply, is up 25% year on year, but prices of goods and services are hardly rising, and that's because consumer spending and capitalist investment is down hugely. We've looked at this before. This is the velocity of M2 money stock, right? It's very low. We need money circulating in order for inflation to start taking hold. The trend matches the downturn in the rate of profit of capital and consumer price inflation. So as the monetary velocity goes down, so does the rate of profit of capital and consumer price inflation, obviously, because money's not circulating, so people aren't buying things, which means they aren't buying things from businesses, which aren't earning as profit. And of course, if you aren't buying things, then inflation is generally kept at bay. However, that situation will change when the lockdowns ease over the next year, whatever the virus does. Then profits and wages will rise, not to the same levels as before, but still up. If central banks pump in yet more money and credit, then prices will rise because economic growth will remain weak. Demand will exceed supply. The hoarding effect will dissipate and prices will jump. There's one estimate of inflation that rates could jump to 4 to 6%. He believes 3 to 4% next year, so who knows? But that's a very interesting article. 53% of restaurants closed during COVID lockdown have shuttered permanently, Yelp data shows. More than 20% of businesses closed in April have reopened. The highest numbers of businesses closures listed in the app compared to other industries, and the rate of closure has remained high. Of the businesses that closed, 17% are restaurants, and 53% of those restaurant closures are indicated as permanent on Yelp. So, I mean, that just goes to show you we're starting to see the effects, I think, very early stage, but we're starting to see the effects of what this pandemic and this lockdown has caused to the business and economy generally. It's not painting a good picture, that's for sure. I think we haven't seen the bottom of the catastrophe yet. I think that'll probably take into next spring through fall, perhaps, to see exactly what the damage, be able to look back at the rubble that this pandemic, this lockdown has caused. Apple Maps driving activity is slowing again in warning sign for the economy. As coronavirus cases surge across the United States, Apple Maps data shows a slowdown in requests for driving directions. The 4 states that are leaders in average daily new reported cases of the past week, which is Florida, Texas, California, and Arizona, have each seen a recent decline in driving direction requests. And here's some maps to show you that. I mean, just you can already see just a small decrease, and likely to get a little bit worse before it starts to get better. Notably, the time period for this recent slide includes the 4th of July, when many Americans typically hit the road for a vacation or to attend a family barbecue. If you think it's because gas is expensive, that's not the case. Nationwide gasoline pricing held steady at around $2.18 a gallon, which is the cheapest for Independence Day weekend in at least a decade and 28% below seasonally normal prices. So if folks were going to drive, now's the time to be doing it with gas so cheap. Here's a small little chart of the 4 states that have been most impacted lately, and you can see that there's a huge dip down as they're closing down again. Noticeably, only Texas had gone to previous highs for the change in the volume of requests to Apple Maps. So interesting. What I thought was also interesting too was this article here: Bed Bath & Beyond to close 200 stores over 2 years as sales fall almost 50% during pandemic. So now they're starting to show you some of the second quarter earnings are coming in, and this probably has something to do with that. And the sales fall almost 50%. Maybe that's good news, and the market is going to celebrate and hit all-time new highs. We will find out in a moment. Dividend payments plunged by $42.5 billion in worst quarter for income investors since financial crisis. That was the largest decline since the first quarter of 2009 during the Great Recession. For the S&P 500, dividends totaled $119 billion, a sharp drop from the record $127 billion in the first quarter. I just wanted to bring your attention to that headline. Just goes to show you that I think the article goes on to mention that the pundit here seems to think that this is the low point of the dividend payment plunge, but we will see. I think we've got more dividend clawbacks to come. 32% of U.S. households missed their July housing payments. About 19% of Americans made no housing payments at all during the first week of the month, and only 13% paid a portion of their rent. That's the 4th month in a row that a historically high number of households were unable to pay their housing bill on time and in full, up from 30% in June and 31% in May. Renters are especially vulnerable. About 36% of renters missed their July housing bill compared to 30% of homeowners. And of course, there's a concern for renters as some of these stimulus and these payments stop being rolled out, like the $600 extra a week from unemployment is going to start taking its toll, I think, on the greater economy. We'll have to wait and see how that all evolves. Wall Street fears market fragility in 23 trillion stock frenzy. It's not your imagination. Stock markets are lurching from meltdown to melt up like never before. Here you can see extreme moves in the volatility lately as compared to historically over the last 20 years. The danger now is that investors are stampeding into yet another cross-asset rally ripe for a violent reversal. This tendency for markets to sway suddenly between extremes, highs and lows, is increasingly a feature of modern trading, and they call it fragility. Fragility events are kicking off 5 times more frequently since the global financial crisis compared to the decades from 1928 onwards. If you just take that name, folks, fragility, that gives you a sense of where things are at, where the economy is at. It's certainly where the stock market is at. It's in bad shape, clearly. This is just another reason why I'm staying away from the stock market, not putting any new money in there at the moment. So we have to be cautious, folks. Things are not as they appear to be. Okay, let's check the markets, see how they're doing, if they're celebrating the bad news. We're also getting unemployment numbers in today. We'll have to see what those are like. Okay, so everything's in the red here a little bit. The Dow 30, especially over 1%. Early days still, we can see it might improve over time as they digest the bad news and think it's not that bad. Of course, we will check gold as well. Here's the gold chart for year to date, up 18%. So I think it's taking a small little dip from yesterday up there, but still looking quite good. Year to date silver chart. Silver's getting up a little bit, which is great. Still at an all-time high, a little bit up from yesterday, it appears like. So good news. Let's take a look at cryptocurrencies. Here's the top cryptocurrencies. They're up a little bit, so they're starting to detach, it seems, from the market so far. We'll see if that holds. XRP looking very strong. I wonder if XRP is on the move now. I think it's a little early, but who knows? I could be wrong. Cardano taking a breather after a big run-up. Where's my Stellar? Holy, Stellar's up 18%. That's unbelievable. I'm not sure why that is. I'll have to look into that and then see if I can do an article about that or a little video here about that. So folks, you can see that as this new data starts coming in from the second quarter, things are not looking great. And so we have to be aware of that. Boots on the ground are showing that the market is very fragile. The stock market is certainly untethered from reality. We know this. We've known this for a while, ever since probably that big bear bull run, or whatever you want to call it, a bear rally, a bull run. Who knows what it'll end up being. I think we've got another leg down at least. So just be cautious out there. Take care of yourselves. I'm sort of looking to pay down debt, putting some savings away for a rainy day, because I think rainy days are coming. My job certainly is uncertain at this stage. I'm on a work from home contract until the end of August, and then we'll see if I still have my job or not. Nevertheless, now's the time not to be spending frivolously, in my opinion. Okay, let's see what the 8-Ball Economist has to say. Thought I'd have an interesting question here for the 8-Ball. My question is, will XLM, Stellar, be worth more than XRP, Ripple by the end of 2020, as we just saw? I was quite surprised at how well Stellar is doing. You can see that here. It's up 18% for the last 24 hours, whereas XRP, still strong, is only up 4%. So my question, I thought I would just put it to the online oracle, was, will XLM be worth more than XRP by the end of 2020? Let's see what the 8-Ball oracle, the online oracle, the 8-Ball Economist says. Concentrate and ask again. Okay, concentrate, folks. Concentrate with me. Let's ask. Most likely. Interesting. It'd be interesting to, perhaps I should actually track these questions, except the problem is, how do you determine them? I have to put dates on and remember what they are, but it'd be interesting to track these in a spreadsheet to see if what sort of success rate the online oracle, the 8-Ball Economist, has over time. Probably be around 50-50, I imagine, but maybe not. Maybe it's actually better than 50-50. Who knows? Anyway, I'm not certain that Stellar will be worth more than Ripple by the end of 2020 or ever, but it's encouraging to see that Stellar is taking off. I certainly am enjoying that, because I own Stellar, as you know. I own Ripple as well, focusing on the top ones. Now, primarily, I'm not putting much money into Stellar anymore, but I am in Ripple. Anyway, there you have it, folks. Thanks so much for joining me. I appreciate you and spending the time with me today. Love your comments down below, and any questions or thoughts you have, please share them. We're in this together, trying to improve our lives, make the best out of a difficult situation. So be kind out there. Take care of yourself, stay healthy, and remember, don't sparrow.